So let's talk about the science behind a piece of advice you've probably heard your entire life. We're going to dive into what's known as modern portfolio theory. It's the framework that took a simple, common-sense idea and turned it into a Nobel Prize-winning formula for investing smarter.
You've heard this a million times, right? Don't put all your eggs in one basket. It's the absolute bedrock of diversification, and it makes sense. Spreading your investments around feels a whole lot safer than betting the farm on one single thing. But for the longest time, that's all it was, just some good advice.
And that's the real kicker, isn't it? How much better is it really? How many baskets do you need, and which eggs should go into which baskets? To get a real answer, we have to go from a folksy saying to an actual mathematical framework.
Well, the answer finally showed up in 1952 thanks to an economist named Harry Markowitz. His work, which we now call modern portfolio theory, or MPT for short, gave investors the tools to finally quantify the whole thing, to put a number on the benefit of diversification. And it completely changed the game.
So here's how we're going to break it all down. First, we'll look at the core assumptions the theory is built on. Then, we'll talk about different types of investors. After that, we'll get our hands dirty with the actual calculations for risk and return and see how that leads us to the so-called optimal portfolio. And finally, we'll bring it all back to earth and look at the real-world challenges.
All right, first step, the ground rules. You see, like any good theory, MPT is built on a very specific set of ideas about how investors and markets are supposed to work. The theory kicks off by assuming we're dealing with a rational investor, someone who wants the biggest bang for their buck for whatever level of risk they're comfortable with. It also assumes we can map out all the potential outcomes as probabilities, and that we all have this sort of internal satisfaction score for different portfolios. And here's a huge one. It assumes that an extra dollar means way more to you when you're broke than when you're a millionaire. That's called diminishing marginal utility. So when it all boils down, every decision is based on just two things: the expected return and the risk involved. Now let's talk about who these investors are. MPT puts everyone into a few different buckets based on one simple thing: how you feel about risk.
So the main character in this story is the risk-averse investor. And let's be honest, that's most of us. We're not going to take a 50-50 bet unless the potential win is a lot bigger than the potential loss. We need a little something extra, a risk premium, to make it worth our while. On the other end, you've got your risk-seeking investor who kind of loves the gamble, and the risk-neutral investor who doesn't care about risk at all. They just want the highest possible average return, period.
Okay, so how do you compare something risky, like a stock, to something super safe, like a government bond? Well, that's where this idea of the certainty equivalent rate comes in. Imagine a stock has a 50-50 shot of making you 20% or 0%. The average, or expected return, is 10%. But would you feel just as good about that gamble as you would about a guaranteed 5% from a bond? If you say yes, then that 5% is your certainty equivalent rate. It's the risk-free number that gives you the same peace of mind as the risky one.
All right, let's get into the mechanics of this thing. This is where we actually start putting numbers to these ideas of risk and return. Don't worry, we'll walk right through it.
Let's cook up a little example. We've got two stocks, A and B, and we have three possible futures for the economy: a boom, a normal period, and a recession. Each of those futures has a certain probability of happening, and each stock has a different return in each scenario. So how do we find the overall expected return? The formula looks a little fancy, but it's really just a weighted average. You take the probability of each scenario, multiply it by the return you'd get in that scenario, and then just add them all up.
So, if we plug in our numbers, stock A has an expected return of 9.9%. For stock B, which does way better when the economy is booming, the expected return is much higher, 17.7%. But, you know, a higher return almost always comes with a catch, and that catch is usually more risk.
So what about that risk? In MPT, risk is measured by something called standard deviation. It's just a number that tells you how much the actual returns tend to bounce around the average. To get it, you basically see how far each return is from the average, square those differences, average them out to get the variance, and then take the square root. That final number is your measure of volatility. Now this table puts all those steps into practice. I know, it looks like a wall of numbers, but just follow the process from the raw returns at the top all the way down to the bottom. All that math boils down to one simple result, a standard deviation of 9.40. That one number is our concrete measure of this fund's risk. Okay, after that complicated risk calculation, here's the good news. Figuring out your portfolio's expected return is super simple. It's just a weighted average of everything in it. You multiply each asset's weight by its expected return, add it all up, and boom! In this case, you get 14.7%. Easy.
So we've got a number for return, and we've got a number for risk. Now we get to the really cool part, the payoff. How do we use all this to build the best possible portfolio?
Well, first, let's look at what doesn't work. If you take two assets that are perfectly correlated, meaning they move in perfect sync, like two synchronized swimmers, you get zero benefit from diversification. The risk and return just ends up being a straight line between the two. You haven't actually reduced your risk at all. But here's where the magic happens. When you combine assets that don't move in perfect sync, you can create these new portfolios that are just better. You can get a higher return for the same risk or less risk for the same return. And when you plot all of the best possible combinations, you get this curve called the efficient frontier. Any portfolio on that curve, like B, is efficient. Any portfolio below it, like A or C, is suboptimal. I mean, why would you ever pick A when you could just move straight up to the curve and get a higher return for the exact same risk?
And this flowchart kind of puts the whole process together. You feed in your inputs, returns, risks, correlations. The MPT math crunches the numbers and spits out that efficient frontier. Then the final step is all about you. You figure out your own risk tolerance and find the one single point on that curve that's perfect for you. Honestly, this is basically the brain behind every robo-advisor out there today.
Now this is a beautiful, elegant theory. But before we wrap this up, we need a little dose of reality. Trying to use MPT in the real world isn't always so simple.
Here's the thing. The model is only as good as the numbers you put into it. It's a classic garbage in, garbage out situation. And as we all know, predicting the future is, well, it's hard. Estimating what returns and correlations are going to be is an art, not just a science. And the complexity just explodes as you add more stocks. For a pretty modest 50-stock portfolio, you need to estimate 1,225 different correlations.
So let's boil this all down. Modern portfolio theory is what gives us the actual math behind diversification. It all works based on a model of a rational investor who only cares about risk and return. The key takeaway is the efficient frontier, that curve representing all the best possible portfolios. And the ultimate goal is to find that one sweet spot on the frontier that's the perfect fit for you and your personal tolerance for risk.
And that leaves us with one final thing to chew on. MPT is this amazing, powerful framework for a perfectly rational world. But we don't live in a perfectly rational world, do we? So how do real things like market crashes or just plain old human greed and fear, how do all those messy psychological quirks challenge the neat and tidy assumptions of this theory? That's a great question to think about.